Okay. Come on in. We're about to get in 1 minute, we're going to kick off the webinar, give you guys a chance to get settled. It's noontime in the DC area. I'm in Bethesda. So as you come in, if you would enter your city in the chat box, and we'll know who's in the room, and we can adjust the conversation for you all. And I see Bill's coming in and Brian. This is great. We got, for August, we got a great attendance on the sign-up sheet. So we're looking forward to doing something really good for you all. Let's see. So if you're just coming in, if you put your city in the chat box, then we'll kind of know who's in town. And Vernon, where exactly are you? I know you're in my neighborhood.
Yeah, I'm in Baltimore.
Baltimore, great. And Bob,
Yeah.
how about yourself?
I'm in Dana Point, California, just south of Newport Beach.
Very nice. We got a good, I see Fernando's from San Diego, Anthony from Ann Arbor, Michigan. We got a good set of people. So Florida, fantastic. Fantastic. So
A lot of California.
yeah.
That's where all the taxes are.
Hey, Rob Daly, welcome to the event here. It's been a while since you and I spoke. Fantastic.
Phoenix, yeah.
Maybe not too long, huh, Rob? Phoenix. Okay. So Bob and Vernon, you ready?
We're ready.
We are. We'll be on time.
We're going to kick things off here. So my name is Kirk. I'm the CEO of Foresight CFO. And in addition to doing, financial management, helping CEOs, build with more clarity and having more cash in the bank, I teach financial management at Georgetown University for grad students. So it's part of, kind of keep up in the bars and capability. And I'm really, really happy to have Bob and Vernon here with us to, share with us on, I don't know if they're the secrets of the uber rich or not, but it seems like that kind of stuff. How do you not pay all the taxes when you sell your business or sell a depreciable asset? So Bob, do you mind taking a moment and introduce yourself?
Sure. No, good morning, everyone. Nice to meet you. I'm Bob Binkley. I'm the CEO of the estate planning team. My focus has been, for the last 21 years on deferring capital gains tax. I've been a financial advisor for now 25 years, going on 26. So, a lot of history and managing money and trying to help clients defer their capital gains tax. This has been my focus for 21 years. And then I formed this company called the Estate Planning Team, where we work with real estate professionals, business brokers, financial advisors, insurance agents, attorneys, CPAs, all of these professionals, that ultimately have their clients that have a need for capital gains tax deferral on real estate, business sales, primary residence, even, commercial property, highly appreciated publicly traded stock, private stock, LLC, C Corp, S Corp, partnership interest, all of that can be deferred. So we've been doing it a long time. And so this company's been formed to keep it all organized and keep it all straight, not only from a marketing standpoint, but from a processing standpoint. So we've done close to 3,000 transactions, not one issue with the government. We have been reviewed. So, a lot of good history that we'll share with you. The government knows exactly what we do. It's 100% legal. We've been, doing this, and standing behind our trust as well, where there's a, there are people out there that are trying to do this, but we tell them, don't try to do this at home. You really need to have a professional. And, again, our company's the one that, created the deferred sales trust. It's ours, it's our trademark. So just for all of you to understand that.
Yeah, Bob, I know more than one CEO who wish they would have met you earlier.
Yeah, that's for sure. I know people have transacted over the years, but they're still got a lot of stuff left in their portfolio and they need help. So we're here to help them and give them liquidity, diversification, and tax deferral. When they see how this works, I think they'll be pretty excited about what all the possibilities of what the structure can do for them.
Yeah.
So Vernon also is a business strategist. He works with us. Great person. Very knowledgeable in the area of tax. obviously you guys, as you have cases, you'll be able to get into Vernon and Kurt, and then obviously up to us and our tax team to be able to look at your particulars on your case. So we'll give you guidance on that as we get into this presentation. But Vernon, would you like to say something about your practice? That'd be great.
Yeah. Thank you very much. Thanks for being here. But I help organizations grow and save money. And one of the leading areas is on tax strategies. I'm real excited about this because I have my own personal story on it, where I wish I'd have met Robert a number of years ago as well. So welcome to be here. If anything I can do, don't hesitate to reach out. I'm happy to help.
Thanks, Vernon. Well, I guess, go ahead, Kurt. I know you got a couple things that you'd like to get done here on these two, this one slide here. So go ahead and take that.
Yeah. So to find out who's in the room so we can guide the conversation to, what's most relevant to you all, I just shared, on a pop-up, the poll, which asked these two questions. First, what was your top line revenue in the prior year? And then the second and last question will be, this year with COVID, do you expect your revenue to increase, decrease, or stay about the same? It'd be great if we get like 10%, or excuse me, 70%. 10% would not be a good response. If 70% of us can respond, it would really help us, kind of figure out who's in the room. And I'm gonna share the results statistically, but your responses will remain anonymous, right? Your specific. So it'd be great. We're at 40%. This is the year to make your vote count, right? Starting today with the Deferred Sales Trust. So we're at 44%. We get to 70, be fantastic. We got a nice sized room here. 50 people who want to get smarter about how to keep more of what they earned. That's one thing I got to tell you I love about doing webinars. I learn from the speakers every week. So a few more votes. I'm gonna keep it open for a few more seconds. We got 62%. It'd make my day if you got to 70. All right, 64, 66. We're almost there. Vote twice. Send your votes in the mail. All right. Okay, I'm going to wrap it up. We're almost there. Almost got to our goal, 66%. So I'm going to wrap it up. And I'll share results with you guys. Okay, here we are, kind of looking at it. So roughly 40% of us, we have a business going 0 to 5 million. So 20% at 5 to 10, and so a big range all the way. Nobody in the 40 to 70, but we got somebody doing 70 million plus. So that on all those upper ranges, lots of taxes to be paid if you do things differently. So this will be good for all of you. And this is always fascinating to me that check this out. I mean, 54% expect their business to increase this year.
Wow.
9% stay about the same. Like a 60-40 split. That's given that the economy is contracting. That's something, right? It must say something about who goes to webinars. We're gonna figure out how to pivot and how to keep going. Fantastic. So I'm gonna wrap this up, and let's get back into the main event here.
All right. Well, we'll get started here. So, thanks for coming. I appreciate you taking time out of your day here, and I just want to be able to just bring you up to speed on the Deferred Sales Trust. So a lot of people don't know what the Deferred Sales Trust. Maybe they heard about it, but they really don't know. I've never heard of this. How do I know it's legal? Well, just understand that the Deferred Sales Trust is just a made-up name. We call it the Deferred Sales Trust. It's our trademark name. But we have what we call a traditional DST, which is really an installment sale. And then we also have what we call a DST Plus, which is really for highly appreciated publicly traded stock or even business sales that have a lot of equipment that depreciation, depending on the straight line or accelerated depreciation. So we have two different trusts. One takes the asset out of the taxable state and defers it so that you can get it to your family without having to pay 40% estate tax. And then the other one is really inside the taxable state and defers the capital gains. And this is really just the time value of money. If you can put your money to work, and in this case, including the IRS's money and the money that you would have to pay to the government, state or federal, all of that money stays inside the trust working for your family. That's the benefit. So owners of highly appreciated assets are reluctant to sell because of capital gains. We want to provide a great solution, a solution that's been tested, or a solution that's been around a long time. So the DST can defer capital gains on almost any type of asset. We've done grain elevators, we've done highly appreciated automobiles, we've done artwork, we've done even Bitcoin, we've done Netflix, we've done Uber, we've done Zoom, we've done many different stocks, private and public, and we've done a lot of investment properties, business sales, even residential, valuable artwork, collectibles, things like that. So all of that has been part of our DNA for many years. And again, our tax law firm stands behind the structure. So you guys, every time you do this transaction, our tax law firm works to protect you if there's ever an audit, because you can be randomly audited. If you are, we handle that audit at no charge, and there's an indemnification in your agreement. So all of this stuff we stand behind, and again, we've never had any issues with the government. And 24 years that our tax team's been doing this, not one problem. And again, the IRS has reviewed our structure, knows exactly what we do, and they know all about the estate planning team and all the stuff. So let's go to the next slide, Kurt. So we're in a perfect storm, demographics, taxation, low interest rate environment. The American Bankers Association are estimating 17 trillion of assets that are going to pass from one generation to the next over the next 20 years. Probably a much higher number, but that's just the number that we've taken. The baby boomers, you're probably all baby boomers. I know I am. So we're starting to retire. There's 77 million baby boomers around the country, and 10,000 people every day are turning 65. So I think there's a knock on your door saying, hey, look, you've done really well, pat yourself on the back. There might be a time that you want to start exiting and getting yourself in a position for retirement, setting up the estate plan for your children, getting everything done so that you can basically enjoy your life and not have to worry about things. And that's really what our goal is just to keep as much money working for you and your family, and be able to get this money over to your children and your beneficiaries the way you would want it to go. Taxation, capital gains rates have increased. You've got still the Obamacare tax that's still in existence, that adds its ugly head to the transaction. And then many states have increased their taxation. And then obviously with some of the corporations that you guys have, S corps have been popular, but when you go to sell, they're not so popular. We can actually eliminate the double taxation on a C corp, but we can do an S corp, LLC, partnership interest, and we can show you how we can defer that capital gains tax. And more money means more income for you, and a lot of other planning that really breaks out to be very favorable for each and every one of you. Again, back to interest rates, we're hovering at an all-time low, 40-year low. Even it's been crazy. Real estate has appreciated over years. So is your business, your revenue. Obviously, some of you have been affected, some of you haven't. Obviously, there's been a lot of printing of money. I think over time, things are going to get wickedly crazy, potentially even inflation coming in the next couple of years. And who knows what's going to happen, but there may be even a financial bubble here that could pop. So, just having liquidity and diversification and protecting your money, protecting your company, not having a concentration in one asset, which has been your largest asset all along. You may want to get out. You may want to get diversified again. Under the 1031 rules, which really doesn't apply to a business, but it does apply to real estate that you own. You have 45 days to ID. Very troublesome to try to ID in 45 days. Most of our clients just don't want to deal with that, or they just, they're going to give up the exchange idea because it makes no financial sense to, buy low, sell high, and then obviously go back into the market at a high valuation. Cap rates are at an all-time low, prices at an all-time high. Do you really want to exchange into a buzzsaw? Your parents taught you to buy low, sell high, and buy low again, not to buy high. So 1031 timelines and restrictions make it very difficult if you're looking at 1031, or if you don't have that option, then obviously a business sale or stock sale, you don't have that. There are some things you can do from a publicly traded stock is, do an exchange funds. We do a lot of that, but The problem is you're going to get another diversified allocation with trading your publicly traded company stock with somebody else's that it's another executive, and those exchange funds are, they're okay. I mean, but again, you're still in the market if you want to exit it and get more liquidity, get more diversification, focus your money in different asset classes that, maybe a foreign asset class or even gold or things that you really want to hedge, or, things that you can't hedge your company right now, very difficult. Again, we can help you get there. Again, back to the exchange, there's a low inventory to choose from. And so that's really been a big problem, is low inventory. You just can't find anything to exchange into, and everything's kind of heated up because of the interest rate environment, the low cost of money. So with that, we'll move to the next slide, Kirk. So what are the options? A lot of our clients, don't sell, they just stay the course. And again, is that going to help you get to retirement? No. There's got to be a time, a line in the sand of when you're going to want to retire. We're not here to tell you you got to retire. We're here to tell you whenever you're ready to retire, or take some money off the table and diversify, get liquidity. That's our goal, is to bring that to you. And then obviously if you're with real estate and you owned a lot of apartments and they've appreciated, or you've owned industrial, or you want to just get out of something that you've got a lot of depreciation, recapture tax, and you need some planning, or you've got an estate tax problem and you'd like to sell and you'd like to conquer the estate tax problem as well as the capital gains problem, then we can absolutely help you. So what are the options? They just don't sell. They keep the asset till they die strategy. Option 2 is really just exchange. If you can find exchange, and I just commented, it's very difficult to find another exchange that works under the time frame. So we're not here to tell you not to buy more real estate, but we can show you that you can buy more real estate in a different way, and we'll discuss that here in a couple more slides down the road here. Option 3 is the deferred sales trust, and then option 4 is sell and pay your tax. I know a lot of you are also hearing about opportunity zones. I would stay away from some of the opportunity zones. Most of them I would stay away from, just because I'm not a big fan of them. I'm concerned that a lot of the deals that were obviously underwritten back when pre-COVID, you're paying a pretty strong large premium for that, and obviously you're not getting any money for a period of time until those condos or apartments or whatever they're building is built out. So I'd be very worried about that. There are opportunity zones that are more getting your income in a very short period, like in the 13th month, where the other ones are 5 to 6 years, and you still get all the benefits. And then there's even better tax treatment with some of the opportunity zones that we're doing. So if you're interested in opportunity zones, that's something that we could discuss. But we do like the idea of the deferred sales trust as your primary direction, because it does give you a way to pivot in all different directions. So it does become like the mothership of giving you a lot of flexibility. Again, 1031s just don't, and you're kind of trapped. So again, we will overemphasize the DST and the flexibility of what it can do. Let's keep going. That next slide, Kurt. So again, DST can defer capital gains on any sale, almost any type of appreciated asset, including business, professional practices. So if you're selling your company, commercial real estate, investment property, high-end residential, major stock positions, valuable art, collectible. We've done even grain elevators in the Midwest for farmers. We've done, you name it, we've done it. We've been around long enough, and we've seen almost every type of sale out there. So private equity deals. And again, if you're looking to acquire stuff, this becomes a great deal for anybody you're trying to acquire. Sometimes in negotiation, that person that's looking to sell doesn't want to pay the tax, so they're holding you hostage to pay as much as they can get out of you, and the DST can be a very good solution for you to help negotiate. I mean, we've even dealt with divorces where CEOs have been getting, in the situation where they had a divorce, and we were able to, they were able to split the assets and sell them and defer the capital gains. But one CEO sold his home for $25 million. We deferred the capital gains tax. He basically got a free divorce because the taxation that we saved basically paid for his entire divorce settlement. So there's some things that we've done that just you never think about, or you don't want to think about. But if these things happen, and they do, they are common, we're here to help, all the different situations where it can be pretty expensive. So let's keep moving here, Kurt. So again, the DST benefits is flexible payment options, liquidity, and diversification. That I really overemphasize because, again, a lot of people want liquidity and diversification in an overvalued market. Enhanced retirement, which you're going to get more money because you're going to get more income. It maintains family wealth, which is really important, the passing of the assets to your children, beneficiaries, without any estate taxes. And then that's really just an additional planning. We can rescue 1031s that are failing. So in the event that you've got a 1031 and you can't find a property, you want to try for a 1031, you certainly can try, and we would be able to help you, facilitate a 1031. But if you fail on it, we can rescue you into the deferred sales trust as a fallback, which is pretty nice to be able to give you the option. But I think once you learn how the DST works and the flexibility, and then also the benefits in how you can buy real estate utilizing the deferred sales trust, you'll kind of exit the 1031. And then, the new administration that's, the proposed administration, Biden's team, they're looking at eliminating 1031 exchange and more importantly, obviously even looking at potentially getting rid of the unlimited step up. So that's our, big thing here. Our goal is to help you understand that we have a lot of flexibility to kind of solve that problem in the event that you're looking and faced with that. So we'll keep moving to the next slide, Kirk. So now let's look at the deferred sales trust, and just understand that these are our hypothetical clients up here, and there's a building that they want to sell below. So let's keep going through the steps here, Kurt. The next slide. So you've got an asset that you want to sell, or your stock that you want to sell, your business that you want to sell. So ultimately, whenever you're ready to sell it, we introduce you to our team, our tax team, your lawyer, your CPA, whoever that is on your side. We will work with them, and we will work with you. Our lawyers will represent you, or you can have your own lawyer represent you, but usually the cost will go down if you have our lawyers represent you and indemnify you and protect you. So that's all part of their engagement. So you obviously have an asset that you want to sell. The question is when and for what price. And so that we're not here to tell you that, hey, you've got to sell it now. We're here to tell you when you're ready to sell it. The obvious fact is that we can make that happen for you and defer. So the steps are really, you're ready to sell. We create a new trust. We actually create a new trust with a third-party trustee. We have 21 trustees across the United States. Our trustees are all, either CPA, attorney would create this trust with our third-party trustee, and that trust and third-party trustee.
Hey, Bob, your voice is breaking up. So, Vernon, we may want to. Hey, Bob.
Is our third party. Let's just say that your asset is. Can you hear?
Yeah.
Yeah, you're breaking
Sorry,
up.
guys. Is that better?
It's better now, yeah.
Yeah, we're kind of surging with internet. I don't know what's going on, but I'll keep moving. Sorry, everybody. So if we have, it just let me know if there's a problem, but we'll keep going. So the trust gets formed and the trustee buys the asset from the client. So what happens here is that the trust would buy it for $5 million. Remember, your basis is $1 million, and the trust would buy it for $5 million. But you would enter into a contract to buy, to sell it for $5 million, but you would actually not take any cash unless you want to pay tax on the cash. Does that make sense? I just want to make sure everybody understands it. So you want to sell the asset to the third-party trustee and the trust that's newly formed. And again, this trust would be formed to either go to your children, or it would be an independent trust that would actually be a borrower of your money. So if you sold the asset, like a real estate asset, to the trust, it's going to buy it for $5 million, even though your basis is $1 million. And when you sell it for $5 million, you're going to do 100% financing unless you want some cash to pay tax on. But Ultimately, the trust would buy it for $5 million. And then the next step, go ahead, Kurt, if you can slide to the next slide there. Then the asset gets sold to the cash buyer. So step one is you sell it for $5 million under an installment. Trust basis becomes $5 million, and it turns around and sells it to the buyer that has cash for $5 million. And then next slide here, the buyer will deposit through escrow into the trust account $5 million of cash that ultimately belongs to you. But as long as it stays in this trust and it doesn't get paid to you, the principal, then you're living on the full $5 million, which is really quite nice. The trust would have $5 million. Let's assume that's net of all fees. And then the next step the monies would be invested. So go ahead, Kurt, and we would send the money to investments that you and the trustee would approve. And then the next slide, the trust would invest those monies, and then those trusts would invest those monies based on your risk tolerance and the types of investment that you would approve in writing, because no money gets invested unless you approve it in writing, you and your spouse. And then the next step is once those investments get made, the income generating on the full $5 million would be paid to the trust, and then the trust would actually start making the installment payments directly to in this case, to you as the seller taxpayer. You're going to get note payments. So instead of living on, call it $3.5 million, and so that's the goal, is that you're living on an extra $1.5 million more money. And that's what the DST does. It gives you liquidity, it gives you diversification, and just you can see that you sold your asset to the trust sold it to the cash buyer for the same basis. Cash goes in the trust. Now it gets invested in liquid buckets that you approve based on your risk tolerances, and the note rate of return is usually an interest rate. So that's, I don't know if anybody, are you guys still having trouble with my internet? Is it going out? Yeah, sorry, this home internet, this work from home doesn't work for me. Not as good as it should. So,
overall, Bob, is good right now. Just for everybody, I mean, the first time through on this, it is, if it's new to us, it's a little bit complicated, but we are going to share the slides with everyone who attended. And naturally, if this seems to fit, or if you're interested in learning more, just contact me or Vernon, and we will kind of go through the details based on your situation. So we'll survive, Rob, with the internet.
Okay, well, I'll just keep kind of going back, but just remember, you're the client, you're selling an asset.
Come back
again.
Yep. Sorry about the interruption. Hey, Vernon, I'm gonna hide your video. Yeah.
I forgot that could help.
It worked. Okay, so audience, it worked so well in the trust runs, and it worked well initially, but something's going on Robert's side. So Vernon, are you able to speak to the next slide here?
Yeah, so the funds were purchased based upon the risk allocation that you want to have. So what happens is that you go through and put that into the trust. Next slide. And it's funded with an FDIC bank that's paid. So interest is paid back to the trust account. Keep walking through it. And payments of interest or principal are made to the client per terms of the promissory note. So you set up a promissory note with the trust, and the money's coming back. So
sorry, guys.
Yep.
I'm back. I apologize. It's getting crazy here. Anyway, so yeah, I think everybody's got a good understanding of mechanics, but we'll dive. Can you guys hear me again, or is it still?
Yeah, we can hear you. I turned off your video.
Yeah, we can hear you.
Okay, good. That's perfect. So yeah, so the funds would go into your trust, and this trust could either be owned by your family, or it can be set up to be owned by the trustee, depending on which trust we're using. And again, we put all the money into an FDIC bank, $6 billion bank, and then we hold all our money into in a trust account that's held at either TD Ameritrade or the bank. I mean, again, our goals is to make sure that your money's safely protected by what we call a DACA, Designated Account Control Agreement, and that gives you the ability that there's no ability to lose your money to fraud or anything like that. It's all protected. We do use, there are people that have on this presentation that work with captives. We absolutely have done work with captives. So if you want to exit your captive insurance, we'll buy the captive and sell it so that we can defer the capital gains back when it comes back to you. So there's a lot of you that have done captive business, or again, your stock or whatever you own outside of the corporation that you have, we can defer tax. But again, in this case, the trust would invest the money in the allocation and get paid back, usually interest only or interest and principal. You'll pay your capital gains tax when you get your principal back, but you ultimately just live on interest only until that time comes. So let's keep moving forward to the next slide. So again, looking at the numbers, business or real estate sale, keep going. We'll click through these. So $5 million sale, just to kind of overemphasize the tax, $1 million basis, $4 million gain, federal 20%, state 13%, that's lovely California where I live, Medicare tax 3.8%. That's a pretty, and then the tax bill associated with this transaction is pretty substantial at, almost $1 million, $1,484,000. And that doesn't even include depreciation recapture. Nobody here on this presentation is going to want to pay that bill. And if we can keep that money working for you, all the better. Again, if I can give you $1,484,000 loan from the government, you owe the money, don't get me wrong. But if I can give you guys an interest-free loan for 10 years, 20 years, 30 years, what can this $1,484,000 grow to if there's no interest being charged on it? That's pretty substantial. And if I can take $5 million out of your taxable estate that's not subject to 40%, or $100 million out of your taxable estate that's not subject to 40%, you can imagine how good this can be for you. Moving forward, let's keep going. Next slide. So again, the allocation of your money, I'm having a little internet problem again, but sorry everybody, it's been one of those days. The internet's bad. So yeah, just the last slide you saw was just the allocation. You'll be able to pick the allocation that you select. We have some of the biggest asset managers. We have insurance companies that we work with that offer amazing rates of return in a 0% environment. So that's the kind of stuff that we'd love to share with you. Normally what happens is we enter your case in our system. We get you on the phone with our tax attorney. We determine if your DST is suitable to move forward. We send you an engagement. Usually there's a lot of questions from your CPA or attorney. We actually will need the language to be provided to your escrow, or however we're going to need to get your stock or whatever transferred into the trust. When the funds are received, either from close of escrow or from the liquidation, we actually create a risk tolerance questionnaire to make sure that you and your wife, if you're married, obviously your spouse and you would be able to make sure the risk of the portfolio is really designed around your risk, both of your risks, so that the note holder understands that the risk tolerance and the rate of return is really designed around them, not just some hypothetical. And then the DST income is really scheduled to go out based on what your cash flow needs are. We'll design that for you. Are you stuck in cement when you do one? No, you could change it if you want to change it. So that's just an amendment to the note. We can do that. We review the cases on a regular basis quarterly. We monitor so you can see your account 24/7, 365 days. So everything we do here is to try to make sure that your note is performing based on what the scheduled investments are, and you'll be able to see that on a regular basis. And we review that performance, what we call a mark to the market, meaning we mark your note to the actual physical market of where your money's invested, and then you can see how it's performing. Keep going. We'll keep moving here. So a lot of questions come back to us is, can we go back into real estate or buy another business? The answer is yes. So we can actually set up the trust, and then ultimately, if the time comes that you could find another business for half the price or real estate for half the price, it doesn't matter. Whatever the discount you guys decide, can we set it up so you can buy? The answer is yes. You can get back into real estate and purchase real estate or purchase another business with the proceeds from the sale of your other business or the proceeds from the sale of your real estate. Or can you go from a business into real estate, or can you go from real estate into a business? Absolutely. So that's the key here. We want to, and we, again, the goal is to spread your taxes out over time, defer the capital gains, use the government's money at no cost, no interest being charged on it, and then obviously go back into real estate or buy a business. And that's a whole nother subject, but we'd love to show you how that works and be able to kind of map out whatever direction that you want to take. But again, it's pretty unique to be able to go back in. What's also nice is that you all know depreciation. So when we buy another piece of real estate, you can actually get a new depreciation schedule, unlike 1031, where you depreciated all your property out, and then you're going to go into another piece of property. That depreciation schedule follows you. With us, you sever it by selling it, and we bought it for $5 million and we sold it for $5 million, and then now we have your $5 million net of all fees in cash, and you want to buy another piece of real estate. Let's say that you could buy a piece of real estate for $3 million, and it used to be $5 million. So we go in and buy for $3 million. You're going to get a brand new depreciation schedule on $3 million. Or with business, you're going to buy a business and need some equipment write-offs and 179 depreciation. All of that can be used as well. So we want to be able to overemphasize certain things that that we can do for each and every one of you by utilizing this trust, and that's something that's really very unique for the DST going back into a business or real estate. Moving forward, we'll go to the next slide. So how do we know it's legal? This is an installment, been around for 90 years. It's a 453 installment. We've been doing 24 years of this. We've been reviewed by the IRS. We've been reviewed by national tax law firms, and we provide audit defense at no additional cost. If you're ever randomly audited, we have a vested interest to protect you because this is our structure. And again, we've done thousands of transactions and not one issue with the government. So this is kind of a, we'll give you plenty of references to speak to clients that have been our long-term clients, and a very high-profile clients. You will know a lot of them, and you'll also just mom and pop clients that have sold their companies. And we will give you a broad range of different people that you can speak to, including national tax law firms that can verify who we are and what we do. They've done business with us. Moving to the next slide, please.
Hey Bob, before we go on to the next slide, we have a question from Paul here, and Paul asked, did you say that S Corp is a disadvantage in selling compared to an LLC?
Yes and no. I mean, we could still work around the S Corp or the LLC. I mean, it's not a problem, but there is some rules that we have to follow, but we can manage to get the S Corp and utilize the S Corp in the Deferred Sales Trust. So just, again, it just all depends. It's every lawyer's favorite answer, but we'll look at each and every case, but usually it's not a problem.
Right, thank you.
Mm-hmm. So we'll go to the next slide. So let's just talk about the fees and really the mechanics of everything here. So the outline of fees, the tax attorney charges a 1.5% on the first million and 1.25% thereafter. Larger cases get much larger discounts. So, our largest case is 125 million. We have a couple cases now over $250 million that we're doing, and so that'll be our. But again, our largest case as we stand here today is 125 million that we closed. And again, the fees are negotiable based on a schedule when you get up over 5 million. Again, we provide audit defense, and we don't get paid until the escrow closes. So, a lot of lawyers will ask you for upfront money, engagement, retainer fee. None of that. The engagement is conditional. So if you don't close, you don't use the structure, there's no charge. We'll do all the work at no charge, help you work and structure your deal, no charge. But more importantly, we'll do all of it. Our minimum fee is $5,000. So there's some smaller cases that lead to bigger cases, but just so you know, $5,000 is our minimum fee. Our trustee management fee on a, is about 85 basis points. And that's the trustee and along with, the financial service fee all in is between the trustee and the financial service arrangement to manage the money is all in at 150 basis points. That's on $1 million and below. As we go over $1 million, it goes down to 120, 110, all the way down to 90 basis points for both. So again, our job will give you the grid, but this is just on $1 million or below. So you can see that. And then there is a annual reporting fee of $250 to give you the mark to market, which is we have a third party auditor, CPA, comes in and independently audits and then provides those audits to each and everybody to make sure that the account's performing, the mark to market, everything's going and showing you all the fees related that you've approved, but yet demonstrating that the trust is performing and making sure that your money is protected at all times. So that's something that we do annually for $250 among all the other fees, which are right here. Moving forward to the next. So really, the easiest way to get started, it's just simple. You just enter your information in at www.mydstplan.com. You'll see a / you'll need to put in a VBROKKE. That is the website that you'll just enter your information in. There's no right or wrong answer, so you don't have to go to your tax return and start calculating. Just enter in just a broad stroke. Hey, I'm selling it for $5 million. My basis is right around $1 million. It's a privately held stock or publicly held stock, or it's a business, or it's a piece of real estate. Just describe what it is. It's how is it held? Is it an LLC, partnership interest? Is it listed for sale? Is it in escrow? Just let us know. And if you can enter that case in, then all our job is to do is to put together a nice illustration for free. There's no cost. Get you on the phone with our tax attorney, have your CPA speak to so the goal is that everybody gets this case in the system so that we can give you all the ideas of what it looks like. And then whenever you're ready to sell, it could be now, it could be a year from now, it could be 5 years from now, but whenever it is that you'll already have all this information, and whenever you're ready, all you have to do is let us know that you're ready to sell and you're getting ready, and we'll do the work at no charge. Again, the attorneys don't charge any money up front. They get paid at the close of escrow. So just want you to know that. And we monitor all of it from start to finish to close. So with that, I guess let's go to the next slide. I think we're getting done here, and I'm sorry it's taken a little longer, but if you're interested in joining us today, really just make contact to the team here with Vernon. There's his telephone number. There's his email. I just want to thank you all for being here and appreciate your time to learn about the DST. I'm sorry that we had some internet problems, but that's usually not happening. But I don't know why it's happening today. But I'll hopefully we'll get you a new a recorded copy, or if you want to speak to Vernon, we could do more of a one-on-one with you and go through each and every one of your cases so that we can do it. But guys, do you have anything else to add before we wrap it up here?
Yeah, we've got two questions. First, roughly how long does it take from beginning to end?
We like at least 2 weeks of runway to get things done, but we've had 2 days of runway and people come to us. So, the goal is, whenever, the better thing to do is get ahead of it, way ahead of it. We hate to be rushed. And then there's some things about tax law that prohibit you from kind of going at the last minute. There's a thing called the binding commitment test. And I want to overemphasize that it's never happened to us, but it happened in the charitable remainder trust world, where a client did sell their business or real estate. I think it was real estate. And they were going to go down the road of just paying their taxes. And then they decided in the 11th hour to do a charitable remainder trust, give their money away. The IRS challenged them and said, hey guys, you guys did this in the last minute. So we're gonna call, there's a binding commitment test that you've already were bound to sell and pay your taxes. So we're going to hold you accountable for paying it. So what you really want to do is get to us sooner so that we can study your case, illustrate your case, and then buy your asset, buy your stock, buy your property, whatever it is. And then when you're ready to sell it, we'll buy it and sell it at the same time. But the further you get ahead of this, the better, just because, again, we're on a conditional agreement. So there's no cost to you and there's no obligation. But my goal is for each and every one of you to understand that the sooner that we can get around your case and your illustration, the better, because we don't want the binding commitment test to ever be a problem for you, for any of you. So again, we can do this if you're already in escrow, as long as you haven't removed your contingencies. Then we would obviously slip the trust in and make the deal. Or if you're already down the road of a 1031 on property sales, can we actually insert the language of our defeasance agreements into your exchange agreement with your QI and have it so that you can default in the DST if your 1031 exchange fails? That's another provision that we can do. But the key is us getting to you before you close escrow, or before you're, or if you're going into a 1031, even if you're at a 1031 stage, we'd like to catch you before day 45, before you ID. Can we do it after? Yes, but our goal is to try to catch you as early as possible. So reach out to us as soon as possible, and let's see if we can help you get a good understanding of how the trust works, and then obviously look at it from the standpoint of your position, and see if this makes sense for you. Anything you guys want to add, Vernon or Kurt?
Yeah, I think it's good. We got a number of questions coming in. I'm going to ask, since we're at time, and they're very specific questions about people's individual circumstance. So hey, definitely contact us. I mean, Vernon is the easiest person to talk with. It's worth a conversation to see what we've done for you. So
yeah, please reach out to me. I'd be happy to work with you.
Yeah, and the numbers that Bob showed are real. I mean, this is time tested. It's it's doable. So it's worth. I didn't realize 2 weeks, but minimal 5,000 up. The price point's pretty good. A couple weeks, maybe plus or minus, and you got a solution that could really pay off. Just to bring things home here, I want to put some light on what we do at Foresight CFO as Growth CFOs. We get real intentional. As a business owner, you're thinking about you're building your business. A lot of times you want to have the financial resources to do what you want when you want at different points in your life. And so we get real intentional. What does that number have to be on the check when you decide to step back from your business? And first of all, how do you know that that's the right number in your use period? Is that sufficient? Well, we combine that kind of objective setting with this kind of tax planning. It creates a lot more kind of avenues and options that maybe you don't need that number. Maybe with tax planning, if we get something sooner or at a different price point, it works for you, or maybe we can beat your price point. And what does that do for you? Either way, the deferred sales trust really improves the tax outcome. So at Foresight, we help CEOs get to that number by winning more customers, keeping the ones they have, having the right people doing the right things, access to capital, and really driving up that financial performance and increasing profitability, accelerating cash, which feeds right into maximizing the value of your business. We do this through Growth CFO work. This is not your tax preparer. This is not your accountant. We also do outsourced accounting, but the exciting stuff is that Growth CFO work. So in my case, if you want to know more about how do we go from A to B to maximize your valuation, for tomorrow's benefits as well as your profitability, definitely I can do a financial health check with you to get our arms around that. But then in the meantime, if you're ready to talk deferred sales tax, Vernon, he's your guy. Even a 15-minute conversation about your specifics could be eye-opening. So we're at time. For the specific questions in the chat box, please reach out to us. We'll at least give you something to chew on. Okay. Sorry about the inconvenience. We're going to send the slides out to everybody. We'll get the word out. So talk with you soon.
Great. If there's any questions, don't hesitate to reach out. Look forward to hearing from you.
Have a great day, everybody.
And Bob, thank you so much. Vernon, thank you so much for jumping on with me. I love what we're doing here.
Absolutely. Anytime.
Thank
you guys
you, Kirk.
have a great rest of the week.
Yep.
Have a good one. Bye-bye.
Thank you. Bye-bye.